How to pick a mutual fund? It's a question I am asked often, and until a few years back, it's a question even I used to ask others. Of course, back then there weren't many YouTube videos to help us out, but what was true then and is also true now is that every advisor, banker, YouTuber, relative seemed to have a method of their own. And so in this video, I shall take you through my approach, which is based on my view of the world and my experience. This video will be a little freestyle, but hopefully by the end of it, you would have some nuggets of information that you can start applying today in your own investing strategy. And with all due respect to debt funds, I'll be focusing on equity funds in this video. So let's begin. As I record this video, there are 1,147 open-ended schemes across 36 categories that we can invest into. Now, choosing 4, 5, even 10 schemes can be a tough ask, and there will always be that temptation to invest in a lot of schemes. In fact, full disclosure here, I am currently invested into 70 schemes, which is a big mistake on my part. And I've been trying to reduce this number, but because I have a lot of debt schemes and taxation is an important factor there, I've not had much success with my pruning exercise. So that you don't fall into the same abyss, here's my advice number 1. Be very clear about your asset allocation mix. In other words, the funds you pick should not be random thoughts and should fit in properly with your desired asset allocation. I'll make a separate video on how to allocate across assets, but in my case, and after a lot of experimentation, I am most comfortable around a 65-35 equity non-equity mix. So it's a bit like shaping one's portfolio like a balanced or an aggressive hybrid fund, but a 65-35 does not mean I am not flexible. In fact, on many occasions, I've gone as high as 75% in equities and have also brought down my equity allocation to as low as 45%. I don't really time the market, but I like playing the odds. So when equities are depressed, I would transfer money from debt to equity, and when equities seem to be overvalued, then I would move some money from my equity schemes that I don't like, and I'll move this money into debt funds or arbitrage funds. But the reason I do all this is not in the hope of getting some massive returns, but it's because I want to be comfortable with the status of my portfolio and I want to sleep well. And as of today morning, my portfolio is at 58% equity and 42% non-equity, which is mostly in debt and a little bit of gold. But to keep it simple, let's say this ratio is 60-40. Okay, now the 60% I have in equities has to be split further into large caps, mid caps, small caps and international investments. Again, it's a matter of one's preference, but for me, the ideal split that makes me comfortable is 50, 20, 20 and 10. That is 50% in large caps, 20% in mid caps, 20% in small caps, and the remaining 10% goes into international funds. Why 50% in large caps? That's because it gives stability to my portfolio. The 40% in mid caps and small caps acts like a fertile ground for multi-baggers, and the 10% in international funds satisfies my diversification needs. So I'm a lot more bullish on India, and on an overall portfolio basis, there's 30% in large caps, 12% each in mid and small caps, 6% in international and 40% in debt. So this is my comfort zone, and there is every possibility that yours might be a bit different. In fact, I'm hoping this portfolio mix will be different for you because we both have different incomes, we save differently, our investing patterns, risk profile, instrument preference are distinct, etc. And speaking of instruments of investing, another point of note is that a majority of my small cap investing is via stocks rather than mutual funds, while all of my large cap and a good proportion of mid caps are invested via mutual funds. Okay, now that the skeleton is ready, it's also important to know what not to do. And I've already listed out these in my video on mutual fund mistakes. So if you haven't subscribed to my channel or told your friends about it, then please do so, because there's a lot more useful stuff I've planned for you in the coming weeks and months. Back to the mistakes, and of course, you shouldn't generalize or thumb rule those mistakes as they've been based on my experience and my preferences. But to quickly summarize, I would think twice before investing in an SIP via regular plans, investing through the NFO process using sectoral funds, credit risk funds, debt funds with low AUM, etc. So check out that video. I'm sure it'll bring back some memories from the past if you have been investing for a few years. Now, an equity fund is a basket of stocks, and let's face it, you and I have no say in what goes inside that basket. It's something like sitting in a super safe car without knowing the kind of driver who's going to turn up, which means picking a fund is all about picking the fund manager. And unfortunately, not a lot of material is available on this subject. At least I could not find much. But if you're keen to know more about who is managing your money and how he or she is managing it, then do what I do and try to read up and listen to some interviews that the fund manager has given in the past. You learn a lot from that. For example, Prashant Jain, who was previously the CIO of HDFC Mutual Fund, is a strong believer in value. How do I know that? It's because almost every interview of his will have words like margin of safety, risk and reward, herd behavior, intrinsic value, etc. Likewise, there is Jinesh Gopani, who heads equities for Axis Mutual Funds. And because he seems to prefer the growth style of investing, his interviews will be layered with words like earnings growth, long-term story, growth runway, capital allocation, P multiplier, etc. Now, I've tried shortcuts in the past. For example, Value Research Online has this 3x3 matrix with the market capitalization on one side and the style of investing on the other. My advice is please use these icons merely as clues, but if you really want to improve your mutual fund picking skills, then I highly recommend you stop treating the investing styles as a statistic, but try and make it a part of your own identity. Let me explain that using these two gentlemen once again, Mr. Jain and Mr. Gopani. So 2018 to 2020 was a very tough period for Prashant Jain's value investing approach. And in spite all of the brickbats, it's my belief that Mr. Jain did not abandon his value investing style that he is identified with. Now, like sectors and companies, I think investing styles also work in cycles. So while 2018, 19 and 20 was bad for value, it was very rewarding in 2021 and 2022. The exact opposite happened with Mr. Gopani's growth strategy, where his funds were the cream of the crop in 2018, 19 and 20, but have struggled more lately. But the important thing is, I don't think these two fund managers will suddenly adopt a different style. And as an investor, this can be very comforting to me because I know what to expect and can shape my portfolio accordingly. I hope you're getting at what I'm hinting at, but yes, I do understand this exercise can be a bit tough. So I'll definitely have a follow-up video on this channel where I'll try to evaluate the styles of maybe 8, 9, 10 different fund managers. Alright, now because I have understood that every fund will go through periods of elevation and depression, I've also made it a habit to not look too much into historical returns. But this was not always the case, and like many others, I used to look at 1-year returns, 3-year returns, 5-year, even 10-year returns. And I would not only look at the trailing returns, but I would also look at the rolling returns. But now I put a larger focus on consistency over benchmark, and I'm a lot more accepting even if the scheme's performance has gone below the benchmark in 1 or 2 years. In fact, I follow as a part of my equity fund selection process something called the 2-to-1. So 2-to-1 means in the last 5 years, the scheme was well above the benchmark in 2 years, was somewhat around the benchmark for another 2 years, and may have been below the benchmark in 1 year. It's a bit like football, 2 wins, 2 draws and 1 loss, which is not enough to win the Premier League, but still gives you a shot at qualifying for the Europa League. Simply said, this 2-to-1 approach helps me on 2 counts. One, by making consistency my hero, the system stops me from using recent information in evaluating a fund. And secondly, this approach actually improves my performance odds over the long term, as I now have a decently good fund with an above average track record. Now, once I have a list of possible equity schemes to invest in, and this is generally not a big number, maybe 7, 8, 9 schemes. So once I have that list, I also try to understand how many sectors the fund is betting on. Notice I didn't say which sector, I said how many sectors, and that's because I'm perfectly okay if a fund is betting on just 5 or 6 sectors. After all, that's the fund manager's conviction. But what I want to avoid are funds that are betting on just one sector, or maybe they're betting on 15 different sectors. Also, many investors look at the expense ratio when selecting funds. Personally, I am not a stickler for the lowest expense ratio, but I still want to have a reasonable number here, which means anything less than 1% is perfectly okay with me, as it gives the fund management team enough incentives to do their job, and the fund house is likely to not cut corners in terms of collecting information, recruiting analysts and researching stocks better. And the final area I want to discuss is the role of passives in my equity fund selection process. So I caught on to passives maybe 2 or 3 years back, and today almost half of my SIPs are in passive funds and the other half continues in actively managed ones. But as a portfolio, active funds continue to have about 80% of the asset value, but I'm sure that percentage will come down gradually over the years. By when will that happen or by how much, I think it's a bit too early for me to say. Alright, so let's put this all together and see where I am currently at. So as I told earlier, I made some mistakes in the past and I have 28 different equity schemes at the moment, which will take some time to clean up. But let me be specific about the nature of SIPs I have. So I have 9 SIPs running, and more importantly, the schemes I have chosen ascribe to my asset allocation preference. In case of large caps, which if you recall is 30% of my total portfolio, so I don't have an actively managed large cap fund currently, but I do have a factor-based fund, a flexi cap fund, a multi-cap fund, which is my favorite category, and an ELSS fund. When it comes to mid caps, I have one SIP from a factor-based scheme and another one which is an actively managed mid cap fund. For a small cap SIP, I invest through an actively managed small cap fund, and in case of international funds, I have one actively managed one and another index based international fund. Now I'm not going to give the name of any of these funds.
What? Then what are we doing here?
What we are doing here, buddy, is that we are trying to figure out a framework that can work for you in most situations and which is customized as per your present conditions rather than mine. But one thing I can tell you is that for many of these SIPs, I've been investing in them for more than 5 years and I still don't see any reason for me to move out of them. In fact, data shows that the longer you stay in a fund, the scheme's original selection becomes less and less important. I mean, look at this table of FlexiCap funds and their 10-year SIP performance. Now, if I ignore Quant FlexiCap, which seems more like an outlier, the next 9 schemes in this list comes within 1.5% or a maximum of 2% of each other. It is data-driven information like this which keeps me away from historical returns, and I focus more on how the scheme fits into my asset allocation, the fund manager's investing style, the consistency of performance, sector participation, avoidable funds, etc. And that, ladies and gentlemen, is the way how I pick my equity mutual funds. Now, it's entirely possible that you may not agree with many parts of this, and that's a good thing, because then it tells me that you have thought through your own process and are not relying on some YouTuber to give you a list of 5 equity funds to invest in. On my part, I have tried to keep this video as practical as possible, and if there are any complaints about me not specifying which mutual funds to invest in, or the ones I already have, then please accept my apologies and regret in advance. My focus here is not to take a decision for you, but to give you a framework by which you can make the right decision for yourself every single time. If you like this video, then do tap on to the like button. Do subscribe to my channel. Please share this video with your friends, and I'll see you next week. Until then.